Hey friends, this is Dave. Welcome back to another video. Please hit that like button to help out with the YouTube algorithms. And if you haven't joined our Discord, link down below in the description as well. If you are enjoying the content, please hit subscribe. It'll really help out the channel. So for today, I really wanted to talk about the overall macro markets as opposed to one individual stock. I don't usually focus too much on the larger macro market picture. I just try to pick good companies, but I think we're actually in an extremely interesting place right now with the stock markets. So I'm watching it very closely, and I think it's worth talking about. So I'd like to go ahead and show you some charts of the Dow, the S&P 500, and the NASDAQ, and show some pretty basic technical analysis, some support lines and stuff like that, to try and think about where the markets could be going in the coming weeks. Let's hop over to the charts and take a look. So first off, this is a chart of the NASDAQ. I'm sure you're familiar with it. We're looking back a couple years now to early 2020, before the pandemic back here. And this is obviously the pandemic drop, and we went up way above it. But interesting to look at right now is we had some market lows in June, then that bounced off a support level. We went back up, and now we've gone down again, and we're getting right around that exact same support level. So it's going to be very big in the coming days to see if we break through this support or if we can bounce off of it again. The technicals do tend to matter in a lot of cases, so this is a very important support line we're looking at right now for the NASDAQ. We can see today, actually, we've had a little bit of a bounce, so it's looking good so far, but there's always the chance that we still drop below this line. Now, if we look at the S&P 500, we got the same sort of thing going on here. We had lows in June that we bounced up from, and now we're hitting that same level again. So we're going to see if we can maintain this support level or if we break through. Dow Jones is a bit of an interesting case here because we're actually already lower right now than the June lows were, but we're hitting right at those pre-pandemic highs, and that is a good support level to look at. So basically we're trying to see right now if we bounce off of this line or if we break lower. If we break lower, there's a good chance with all of these indexes we're going significantly lower. And if we bounce off them, there's a decent chance we're going significantly higher. Let's take a look at why that is. So looking at the NASDAQ here, we're at the support line I showed you previously, and the next support level is basically the pre-pandemic highs down here in the red line. So if we break through this yellow line here that we're almost right on, we're looking at potentially going down another 1,000 points or so to hit the pre-pandemic support and potentially bouncing off of that, or even God forbid breaking through that level and going lower. So if we do break through this current level, that's our next support we're looking at. On the other hand, if we do bounce off of it, we're looking at a bit of a double bottom, which is a bullish signal for the markets. We kind of have a double bottom, which would potentially indicate we'd be bouncing up higher by a decent amount as well. Looking at the S&P 500, similar sort of thing. We're right at that support line. If we break through, we're looking at breaking through to well below 3,500, those pre-pandemic levels. So that's a significant drop from here that would impact all of your stocks. If we bounce off of it, same sort of thing. It's a double bottom scenario, which is a bullish signal, and it could go higher, perhaps even up to that 4,000 plus level. Just to give you a bit of a rundown on what a double bottom pattern is, it's pretty straightforward. We have an example here. It's when we have stock dropping, hits a bottom, and then we go up, and then we drop again, bottom around that same level, and then we're off up again to the races. So in terms of Investopedia key takeaways, the double bottom pattern always follows a major or minor downtrend in a particular security. and signals the reversal and beginning of a potential uptrend. So that's kind of what we're looking for here, is to start a new uptrend and get out of this bear market that we've been in for a while. Basically looks like the letter W if you're ever doing technical analysis on your own. So I'm going to be watching these levels very closely in the coming weeks just to see if we break through this support level or not. If we do, there's a good chance we'll drop significantly lower. And what factors are really driving the overall market right now? What could perhaps decide whether we break through this support or bounce off it and continue up? Well, a lot of it has to do with inflation. The consumer price index numbers came in hotter than expected recently, and just the overall economy has been running very hot. So if we look at the consumer price index, in September, it came in at 8.3%. The forecast was for 8.1%. We want this number to go down. Inflation, we generally want to be below 2% here, so we have a long way to go. We can see back before the pandemic began, we were sitting pretty good, below 2%. We've been giving out all sorts of money, deploying capital to try and boost the economy with this sort of disaster happening, and the impact has been inflation rising, so our dollars have less spending power. This affected the Fed in that they're more likely to raise interest rates higher going forward to try and bring that rate down. Borrowing costs go up. It's harder to get access to capital and stimulate the economy, but it needs to be done in order to bring inflation back down into line. There are actually some good signs, though, when it comes to inflation, the economy, and supply chains. For example, if we look at this global freight container index, we had all sorts of supply chain and shipping issues about a year ago, and we can see it absolutely ballooned in cost to ship a freight container across the world, wherever that may be. We had all sorts of issues with ports, shipping, unions, you name it, and this affects a large amount of companies. Now we're seeing this drop extremely rapidly, which is a very good sign. We want to see this continue to drop, ideally below the 2,500 level, and that will help bring companies' costs down, and they can pass those savings on to the consumers as well. We can actually get the items we need in time to manufacture our products and put things out at a decent price without having to jack up the prices on us even further. So that is one good sign. Not all driven by inflation. Some of it is driven by issues around ports and things like that, but it is a factor that has contributed in the past to those high numbers. We can also talk about gas prices. It's a massive part of the economy. We've seen the U.S. retail gas prices surge for the past couple years, and now that has finally been starting to drop pretty nicely. So having that continue to drop would definitely be a great sign for inflation and the overall economy. There's been other factors at play, like the Russia-Ukraine situation, that have affected this, and obviously the push for more renewables, but we still rely on gas a lot today, and having this number continue to drop is very big for the economy. Quantitative tightening is a big one. People don't talk about too much. So the Fed doesn't just set interest rates, they also have a massive balance sheet that they can use to buy securities and support the economy. They have been a big buyer and a big stabilizing influence in the markets for the past couple years, and we can see their balance sheet has really gone through the roof since 2008 or so. They used to be well below $1 trillion. Now we're looking at more like $9 trillion. And this balance sheet of securities helps provide demand and boost the value. And they have basically committed to now easing back on their balance sheet in order to reduce the size of the sheet, reduce their assets they hold, and ease the support that is giving to the economy to try and help fight inflation as well. But this could also potentially negatively impact demand for securities and the overall market. So something to watch closely. When the central bank began quantitative tightening this past June, it set out to partially unwind roughly $4.5 trillion in the quantitative easing, which was when they raised their balance sheet. that was conducted in response to the pandemic. So we're looking at this line coming all the way back down to probably around here, around the 4 trillion level, and that can definitely have an impact on the overall economy. The question is, of course, we've known this has been coming for a while. How much of all this has been priced into the markets already? If you're more of a bear, you're saying this is really going to hurt the markets. I know Mark in the Discord is often talking about QT and how we have all this to go and it's going to drive markets lower. On the other hand, if you think it's priced in already and we all already knew this was going to happen, then perhaps having this drop is not going to be the end of the world because we've all been expecting it and already priced securities to a level reflecting this change. It's up in the air. I just wanted to provide the information for you to make your own decisions. Let's head back and wrap up this discussion. So yeah, I'm not going to lie. I'm really kind of hoping we do hold the line here, hold these levels and not break through because I'm big invested in the stock market and it's never fun seeing your investments go down. I've been buying Rocket Lab at what I already consider to be pretty cheap prices. I've almost hit my target amount of shares that I'm looking to hold. So I think I'm okay if it stays flat here, doesn't go too much lower or even goes up. I'll be okay with that. And same with a lot of my other companies I'm holding. So that's just me personally. A lot of people out there have positioned their portfolios because they believe we're going to break through these levels and go even lower, in which case they're holding cash or more safe companies. I don't know for sure what's going to happen, but what I have done is position my portfolio so I feel like in the long run I will be okay either way. That's really what I would suggest anyone to do, is to invest for the long term and not the short term. If you have a time horizon of 2 years plus, you should be golden regardless of whether we break through this current level of support we're hitting or we bounce off it and go up. It's just a matter of waiting, an extra year, a few extra months to get those returns we're looking for. If you're not a short-term swing trader, you don't have to worry too much about that. And I really do think overall for most people, long-term investing is the way to go. So that's it for now. Let me know what you think in the comments below. Is the market's going to continue to drop? Are we breaking through these support levels? How are you positioning your portfolio? Really interested to hear what you have to say. I'll look out for your comments down below and see you guys next time. Bye.